All right, a couple more will trickle in, but hello and welcome everybody. My name is Ryan Nash. I'm the CEO at Gust. We are joined once again by Crystal Stranger from now Cleer Tax and Bookkeeping. We've been working with Crystal long enough that this is the third name change. I believe it was Greenback Business Services, GBS Tax, and now Cleer Tax and Bookkeeping. I think it's getting clearer, and we're excited to go a crash course in C Corp taxes. So most of you are startups. A lot of you are probably Gust Launch customers. So chances are you're running a Delaware C Corp or Delaware C Corp is in the future. And anytime you talk about business entity, I'm sure you hear all sorts of things about taxes. There's franchise taxes, there's local state taxes, there's corporate taxes. People talk about double taxation, pass-through taxation, S-Corp elections, all that insanity. At Gust, we know a bit about it. We know franchise taxes. We're the registered agent for some companies, but we are not tax experts. And we caveat all of our tax programming with the caveat, we are not tax experts. If you have a specific question, go consult a tax expert. And this is our tax expert. Having said that word too many times, Crystal's going to get us a run through about all the things to consider in the 2023 year tax update, not just the things that you have to do every year, but also year to year. The tax law changes. And so there's some things to be aware of. As always, we're recording this webinar. We'll send the recording out tomorrow. We've got the chat open, Q&As here. Feel free to throw in the chat where you're from, what your startup's name is. And we're going to save questions to the end, but please use the Q&A to keep nice track of them. And without further ado, Crystal, take it away.
Thank you so much, Ryan. It's great to be here again. Happy to see everyone, to be joining all the Gust Gust clients, Gust startups here. We love startups. A little bit about me. So I'm an enrolled agent. I've been doing tax about 20 years now. So it's been quite a while. And I started out my career in the entertainment industry in LA. So doing a lot of really interesting, multi-entity type work. And then I did expat taxation for a number of years, working with international taxes. And then I came here, I'd become a senior supervisor along the way, came here to kind of head up the tax program at Cleer. As Ryan mentioned, we previously were GBS. Before that, we were Greenback Business Services. So we've definitely had some morphing and changing along the way. And part of that is that just like you guys, we're a startup and we're growing super fast. And we're building out all kinds of technology and solutions to be able to help serve you better and to keep our costs low, right? So that's what we're here for, how we're here to help you. And definitely use the Q&A feature. A big part of this particular seminar is to be able to, get to ask questions and share. I also have Lindsay Anderson on here, who is our business manager, and she's really wonderful. Actually, we've been friends for over a decade, for many years more than we've been working together here. So I'm really grateful to have her on my team and to be able to work together to get lots done and help you all with your taxes. So,
absolutely.
Okay, so first I like to start this with just a little bit about different types of taxes, because there's a lot of different compliance requirements that companies have, and sometimes these are misunderstood or lumped together. So let's just start with kind of breaking this out. So there's income taxes, which can fall under federal income taxes and state income taxes. There's franchise taxes. The most common one you probably have is Delaware franchise tax. There's franchise tax in a few other states as well. Payroll taxes are for employees. Sales taxes are taxes that are based on where products are sold. So based, for the consumer end of things. Excise taxes. And then one that we wanted to touch on briefly is BEA surveys, which there may be some out there in the audience who have a requirement on as well. So the first benefit of corporations, just so you understand why you have a corporation, it's not always the most beneficial structure from a purely tax perspective, although it can be depending on situation. But typically the reason for a corporation is that they're considered a separate person legally. So if you keep the proper records, it shields the investors from personal liability. Because of that, investors often prefer funded corporations And then investors also typically have a preference for Delaware corporations in particular, because Delaware law is very investor friendly, which is why it's normally the recommendation for startups, because a lot of startups are looking for that venture funding, looking for that ability to fuel their growth. And that's, a really good recipe for being able to attract that. Tax on a corporation is calculated separate at the business level than the individual level. So it makes it simpler for investors to manage their personal taxes. That can be a really good advantage. Also, a lot of accelerator programs require a C Corp status. So it's good to get things set up the right way from the beginning so that your documents are kind of in line with what you see in these different programs. So corporations are owned by shareholders. So it's some kind of important terminology there. Just because you're a founder doesn't actually mean you're an owner. You're not an owner unless you're issued those shares. There has to be a formal management structure. So you can't just, fly by the seat of your pants. You have to do a little more formalities of corporation. To be authorized to contract, there has to be a signing party. So typically president or CEO, but somebody with the authority to contract in your bylaws and your documents. Meeting minutes should be kept. I don't know if, generally that's a standard good practice to follow. I don't believe Delaware requires it per se, but it's usually a good idea to have some documentation and backup there. Corporations should be entered into with the idea of earning a profit. I know that sounds kind of obvious probably to everyone here, but you'd be surprised. Sometimes people think about starting corporations for other reasons. And, it's just a little bit of this formalities goes a long way in having a successful business, especially when it comes to tax end of things. So US tax basics, I also like to cover this just to make sure everyone's really clear about, basics kind of in the US. So US individuals, including US corporations, are taxed on their worldwide income, right? So it's not just what you earn in the US, it's what's earned anywhere in the world. And then a tax return has to be filed every year to determine how much tax is owed. For corporations, it's required to file that tax return every year. There's no minimum income exclusion amounts. Then the taxable amount that's actually taxed is your gross income minus any deductions or exemptions that are allowed. Then that taxable amount you can sometimes offset with credits and other things of that nature. An important note is that fiscal year elections can be made in the first full year of filing. You don't have to make it when you first formed your company. If you've not yet filed a tax return, you actually could still change your fiscal year up until the time of filing the first tax return. Sometimes it's done because there's a natural business year, like you have a time of year where you have your biggest profit. You want to kind of end in that fourth quarter of it for the company. It also can be done to match foreign tax year, or a lot of companies these days do it to match Salesforce, which ends on January 31st, because they think it's a smart idea to have through January to complete all those contracts rather than having salespeople trying to close contracts right around the holiday period, that last week of the year when nobody's in the office. So corporate income tax is taxed at, it's a flat 21% tax rate. In general, that always applies. There's a few exceptions. The most notable is FDII, foreign derived intangible income discount. That's certain sales made outside the US can be taxed with 13.125% effective tax rate. Also, there's a GILTI tax rate for foreign subsidiaries of 10.5%. Generally, a C Corp files April 15th. So it's 3.5 months after the end of the tax year. So that would be for a calendar tax year that ends December 31st is going to be an April 15th filing date. If you have the January 31st fiscal year end, for example, your date's going to fall in mid-May. Each year, it's slightly different what date that falls on. It's not typically on the actual 15th. It is about every 3 years or so. And then this year, I believe the April deadline is on the 18th. You also can file an extension by April 18th, and then you have an additional 6 months to file. This year, that extended deadline is October 16th that falls on. And this year in particular, there may be some good reasons to extend. So we'll get into that in a little bit when we talk about how R&D expenditures are being treated differently now. Form 5472 is if there's a foreign investor that owns 25% or greater of your company. This form is required to be attached to your tax return every year. It has a really big penalty, is why I'm mentioning it here, even though it may only apply to a handful of the participants out here. It's really important to know about, because that $25,000 penalty is handed out like candy by the IRS if the return is filed late, and it's very hard to get rid of once it's assessed. So if that applies to you, highly recommend filing on time. Same thing with Form 5471. That's if you have a foreign subsidiary owned by the US company. That $10,000 penalty is very severe, very easy to get assessed and hard to get rid of. This is probably also the most complex tax form in the US tax code to file a 5471. It's a tax return inside your tax return based on the foreign company's earnings. So certainly if you have this, you want to plan a lot more time and a lot more costs to file your taxes. S Corp elections. Now, you probably have heard about this. S Corp elections, in my opinion, are less valuable than they used to be. And that's because the other like pass-through exclusion of income is a pretty narrow window where it really benefits between when the payroll taxes kind of max out, or you would benefit from, the difference between a C Corp and an S Corp, and when you max out on that pass-through deduction. So we don't see as many S Corps as we used to, but it's important to note that S Corps also can only have one class of stock. So there's certain things that people do these days, especially with state and local income taxes, that can end up violating that one class of stock rule. So if you do make an S Corp election, you certainly want to plan and look at a number of issues now. But the big reason for an S Corp election, probably because I should have started with this part, is it gets away from that double taxation, where with a C Corp, you're taxed once at the corporate level, then again at the individual level. S Corp is only taxed once at the individual level. So in some circumstances, it can end up with a lower tax. Not as much these days post Tax Cuts and Jobs Act, though. 83B elections are often asked about by founders. I think Gust does a pretty good job of helping everyone with this when they form. Yes, we don't get it so much from Gust, or not a lot of problems we have to fix, I should say. But it's really important if you are forming a new company or you're issuing new stock, that this has to be filed within 30 days of issuing the stock, or under a vesting arrangement. Vesting arrangements can be snuck into a lot of contracts in funny places. So you have to look at the contracts very carefully when you're signing them. Sometimes it doesn't look like it's a vesting arrangement, but it is, and it still would require this. The problem of not filing an 83B election is on both the individual and the company side. So for the individual side, then all of the vesting is income that comes to you. So, at the beginning, when the company doesn't have any value, there's no tax to pay on those shares that are given to you. But as you raise money, as the company increases in value, then that vesting amount that comes to you becomes taxable income that should be added to your compensation. Problem on the company side is the company side should be telling you how much compensation you have from that. They should be withholding taxes because it's compensation and reporting that to the IRS. For the company to do that, then they have to do, valuations, going and getting the 409A evaluation, all this kind of stuff is added cost, added hassle, everything like that. So this can save a lot of headaches and a lot of tax owed to file this at the beginning of starting a company. So now we're getting into the meat of the changes this year that I really want to talk with you about is the R&E expenditure rules were changed in the Tax Cuts and Jobs Act like over 5 years ago and set to be effective starting with the 2022 tax year. Well, nobody thought these would ever actually make it into being effective tax law. They been talked about for years. They've tried to repeal them for years. They were basically just added as a balanced budgeting, budget balancing measure to the Tax Cuts and Jobs Act, but nobody ever thought it would be real. Well, suddenly it's real. The law to overturn it that Congress was voting on January 3rd failed. It didn't get voted in. So this is indeed law now. And it's a big challenge to contend with for our startup clients. So starting with the 2022 tax year, the R&E expenditures can no longer be expensed. They have to be amortized over a 5-year period or 15 years if those expenditures are done outside the US. That's, a huge impact because a lot of development is done overseas. It's, pretty common now to hire developers in other countries. And this is a very broad rule change. This is not just the same type of expenses that would be qualifying expenses for R&D credit. This is basically everything development related when it comes to software, because there's a line in 174 that specifically speaks to software development. And in my research on it, it's so broadly blanketing software development that I've heard it argued an IT department writing a single line of code would then be at R&E expenditures. So it's really, there's not any way around it for software development specifically. It is such a clear definition in there. There's a lot of other areas though that need more clarification, which we'll get into in a second. But it's very different. R&D for the credit, R&E for the expenditures and capitalization, incredibly different. So the important thing to note also is a mid-year convention is required. So say you have $100,000 in development expenditures that were made in 2022, $10,000 of that is currently deductible against your 2022 income. So, and then the next year against your 2023 taxes, $20,000 of that will become deductible. That's how a 5-year capitalization period with a mid-year convention is going to pan out on a pragmatic way of looking at that. Also, the changes for the R&E are considered a change in accounting method. So additional statements have to be added to your tax returns this year about this. Loads of joy, right? So let's explain this a little more in depth. So prior to 2022, a company could elect to deduct R&E expenditures even for software development that hadn't become active. So let's say you were building a new SaaS product. It's a 3-year out timeline to release that product. You could deduct the full amount of those expenditures against your current year income. Also, you could make an election to capitalize and amortize the costs over a period at least 5 years, or you can make another election to capitalize and amortize it over a 10-year period. So there were 3 different ways you could treat this. Now that's gone. You have to capitalize specified research and experimental expenditures, which specified sounds specific, but it's not. It's incredibly broad. Must be amortized over a 5-year period or 15 years if outside the US. That mid-year convention's required. Basis recovery is not allowed. So previously, if you disposed of the product, you had made one of those elections, you gave up, you decided not to continue with the development, you could expense the rest of it in the current year. You can't do that anymore now you have to continue to amortize this over the 5 or 15-year period, no matter what happens, even if you later abandon the project or don't do anything with it, right? So that's looking deeper into this, some possible included activities. Like I said, the software rules incredibly broad. So that's something that you definitely want to look at. It's, you know, it's really just so broad at the moment. Ordinary testing for quality control. That's one of those items that's not allowed to take an R&D credit against, but it's probably going to be included under R&E. Management or director studies. So say you're doing a study for SEO keyword searches. That's probably an R&E expenditure. Market research studies. You know, if you're, you know, doing some demographic searches, like that kind of thing, like trying to determine that stuff, hiring a consultant for these things. Improvement of an existing product. I mean, how broad is this? You know, the question I had today on a call was, if you are building a website for your company, would this end up being R&E? Well, I mean, if you're just using off the shelf, like no code tools, probably not, you know, because it's like a marketing expense then. But if you're doing custom coding, it probably is, right? So it's really, I think it's gonna not only if this stays law. I mean, I'm still hopeful the law will change and this will go away. I'm hoping and praying for this, that Congress comes back together and, you know, comes to some agreement, because there's bipartisan agreement to get rid of this, right? I don't know why it's still here. But basically, if this continues to be law, I think it's going to have a lot of rippling effects on business in the US, on fundraising in the US, on what types of products people buy, how they build websites, how they build other types of business products, what they're looking for, because, you know, it's so broad and can affect so many areas of a business, and is really a massive tax increase if you start to look at it.
Crystal, we had a couple questions in the chat that I think, Lindsay, you're getting to, but it'd be good for everybody. Everybody's thinking about, like, well, what about if I'm a salaried person and I'm a software engineer working on my startup? Like, I don't track, like, if I'm doing keyword research or building software, like, I don't track that independently. How could I pay taxes on that? Are salaries treated separately? Then, like,
you have to treat it, you have to track it now. You have to apply. I mean, I would apply the same methodology that's used for R&D credits, where you apply a percentage of activities. And the recommendation I normally have on R&D credits is to go back and pick like a few weeks at random, like one per quarter, look back at your calendar and count up how many hours you've spent on different activities. If you have to look back at it and you can't track it, like looking back at 2022, that's what I'd recommend. Pick like 4 sample weeks and go back and rebuild what percentage of activities you did on what types of things during those 4 weeks. So
is this now, if this stays in place, it used to be the R&D tax credit was kind of like a perk. If you knew about it, you could get some money back and, you know, some additional runway for good activities and trying to improve and innovate the companies. But now it almost seems like that is an essential thing to apply for, because if you don't, you're going to be losing out on this because of the R&E.
The qualifications are different.
Okay.
You know, so, and we'll talk about that in a minute. So I like, that's why I like to do questions at the end, because some of these questions are going to get answered.
Gotcha.
So so these, yeah, so there's other issues though with the R&E that we haven't talked about yet, and it can kind of make your head spin. So I want to go into it a little bit. So this is the list of specifically excluded activities, is 2 things: acquisition or improvement of land, and acquisition or improvement of property that can be depreciated or deleted. However, this opens up even a bigger can of worms, because it then goes on to specify the depreciation and depletion amounts can be considered expenditures that have to be capitalized. And this isn't exactly clear if it applies to property placed in service in prior years, or only if you're placing it in service this year. So let's use an example. Let's say in 2021, you bought $20,000 worth of computers for your business and you decided to depreciate it over 5 years instead of taking special depreciation, right? So in 2022, then, if it's straight line, which is easier than makers, you're going to have like $4,000 worth of depreciation on that you would normally be able to take against your expenses this year. Well, the question here is, does that $4,000 get added in to the R&E expenditures that has to be capitalized because those computers were used for research activity? So does that then suddenly have to, like, you don't get to deduct the $4,000, you have to adjust out of your depreciation, add the $4,000 into your R&E expenditures, and then take that $4,000 over the next 5 years. I mean, it's like head scratching how this law is written, right? It's really, it must have been written by an intern. So it's really bad. And I suggest even going, and if you search IRC 174, you can read it. It's only about a page long. It looks very inoffensive if you read it, but it's not. But it's very vague because it's very short. So it's, like I mentioned, it's considered a change in accounting method. So it requires additional statements attached that require you to disclose the amount and details of the R&E expenditures. So not only now do you have to change all these methods, but you have to add all this additional record keeping and disclosure to your tax return this year. So yeah, that's kind of the R&E side. R&D credit now. So R&D qualifying costs have to be spent in the US. So anything that's R&E outside the US, of course, you can't get an R&D credit for. There's a 4-part test that has to be met for software specifically. That's actually quite difficult to qualify for. You can't have any internal use software, except for like a small safe harbor provision there. Also, all due diligence for R&D credits has to be performed prior to filing the tax return, not in advance of audit. The IRS has been very effective at winning tax court cases in this area. And they, they're very strict now on these rules, and it's only a matter of time until they start large, wide-scale audits of R&D credit. So starting in 2023, though, there is a benefit that the amount you can deduct against payroll is going to be increasing to $500,000 over the current $250,000. So you'll get $250,000 against Social Security and up to $250,000 against Medicare. So that's a big increase for the following tax year, that you possibly can get more in the R&D credit, assuming that you're able to qualify this, right? There were 2 IRS memos that were very strict about that. Also, yeah, I think that litigation risk, as I mentioned, is increasing. There's been a lot of companies, charging a percentage for R&D credits, not doing the due diligence process, not even really qualifying people very well for the R&D credits, and paying, the audit lottery, because, audits have only been 0.2% over the last decade for businesses with less than $1 million in revenue. Prior to that, it was like 2.5%. So it's substantially lower now. And the IRS already, Lindsay forwarded me yesterday a IRS like help wanted thing where they're hiring people straight out of law school now, and specifically for LB&I, Large Business and International, and SBSE, Small Business Self-Employed. So I guarantee everybody's companies who's on this call fall under one of those 2 departments that the IRS is hiring, new lawyers to come in and start being auditors for, right? They've announced they're trying to hire 87,000 new agents. I don't know where they're going to find 87,000 people, but I calculate if they really do that in the next 2 years, also with the rate of IRS, retirements that are scheduled, all this information is public knowledge, right? It's all, Tax Advocate puts all this information out, public knowledge. I went through, I ran the numbers, and the IRS is going to be 2 new agents for every 1 experienced agent in like 3 years' time. So when you're getting audited for the 2022 tax year, the odds are it's going to be a brand new agent who's going to try to throw the book at you for everything they can possibly get, because that's how they make their name in the service. And they're really emboldened at the moment because they've been winning tax court case after tax court case. So, should you still claim them? It's like, yes, there's more benefit now. The amount that you can claim against payroll taxes is increasing. The R&E expenditures makes it even more valuable to get the R&D credit. But the problem is that the risk of litigation is so high, you have to have a certain amount of R&D credits to make it worthwhile, both financially and on a time perspective. Like, we do a flat rate R&D credit product. So I work with people to do R&D credits, and the people who come to us for it, I calculate that, a founder is going to spend minimum 20 hours just putting together the due diligence documents that they need for us to do proper due diligence in order to file an R&D credit. So it's a really substantial time commitment when you're building a company. And that's for a single business component. If you have multiple business components, it can be that much times your number of business components, because each one has to be documented separately. So R&D credits, they're wonderful. I love them, but they're also like getting harder and harder to justify in a lot of ways. Okay, so moving on, that's the big bulk of state income tax, or sorry, federal income tax. Federal income tax is always where a lot of the challenges are. There's more changes, which we'll discuss in a little bit, but let's run through some other types of taxes so we give you a little more broad overview, because this isn't just supposed to be a federal corporate update, right? So on the state side, state income tax is another thing that's changing a lot right now. What's considered nexus, meaning the minimum contacts that you need in a state in order to be considered taxable as a business in that state, is getting, you could say, slimmer and slimmer each year since the pandemic. Well, and even prior to the pandemic, there was a tax court case, I mentioned in the sales tax, which is Wayfair versus South Dakota. And it really opened kind of a Pandora's box to allow states to tax interstate business much more heavily than previously was allowed under kind of the constitutional restraints that have been brought up in prior court cases. So this is like, certainly if you have a physical presence in a state, if you have an agent there, an employee there, with the exception of, there's a salesperson exception under I think it's PL 86 public law that allows salespeople who are taking orders and remitting them to an out-of-state headquarters are exempted. So that's usually like the main exemption that will apply, but definitely state income tax is something you need to look out for closer now. Delaware franchise tax, I think everyone on here has a Delaware Corp. It's this time of year. Delaware franchise tax is due by March 1st. So don't forget to file it, because Delaware will assess penalties on there. The big key for Delaware franchise tax is to issue shares. I like to recommend 70 to 80%. That way you get a pool for, equity investment and options. But, the key is to have that, don't have 1% of your company issue, right? Sales tax, I already mentioned South Dakota versus Wayfair. The big ones I get questions about are service income. So only two states typically tax service income, Hawaii and New Mexico. They both have pretty high economic nexus thresholds. So usually that's not an issue on sales tax if it's a straight service business. If you have a SaaS business, though, it's totally different, because software had this history of coming from when it was like physical products, like floppy disks and that kind of stuff that most entrepreneurs these days have never even seen, except maybe a picture and, on Wikipedia. But that's, it used to be a physical item that the states got a lot of tax revenue off of, right? Like Windows used to charge a fortune for the hard copy versions of their software. So states feel the pain of losing this revenue, and many of them have said, no, we still want a piece of the pie. So they've gone on to make laws that tax digital downloads of software, that tax software as a service. It's about 50-50 on which states tax SaaS or don't. So it's something to look at closely when it comes to sales tax in particular, if that's your business model. Drop shipping is the other big thing that gets people into trouble if you have an e-commerce type business, because drop shipping through online marketplaces is taxable in most states now. So it doesn't mean you necessarily have to register and pay in every state, but it can be really hard to figure out exactly which states and when you need to get registered for sales taxes. Onto payroll taxes. So the first thing about payroll taxes to look at is the great argument of, do you have independent contractors or employees? Generally, if it's inside the US, every state has their own rules. You have to look up that state's rules. Typically, there is a control test where it's the biggest item is whether the employer has control over the time, place, type, equipment, all that kind of stuff of those activities of what the worker does, or if the worker gets to choose all of those things and how they're doing their job, right? But it can be different in different states. California has passed some strict rules. It's changes a lot from state to state, year to year, everything like that. So it's certainly an area to keep an eye on if it affects you. Payroll taxes are the FICA, so your Social Security and Medicare, that have to be withheld from the employee and paid to the IRS. If you ever run into cash flow crunches, make sure to pay the IRS first when it comes to payroll taxes, because the Trust Fund Recovery Department of the IRS is the most vicious department there, and they will go after you personally. Without a doubt, they will go after your car, they will go after your house, they will go after your spouse's income. So make sure that if you ever hit a time where you're wondering who to pay the IRS. Those, withholdings on employees are not something to ever use to cover anything else. So also, there's a lot of compliance issues you can trigger with employees. I'm not going to talk on this a lot because I know we have a lot of questions, but if you have payroll taxes, actually, if you're going to have employees, I should say that my recommendation is to use a PEO service. So a PEO service they hire everyone as the employer of record. There's a lot of good ones out there. Just Works is really good. Deal has gotten really popular, although they're kind of expensive. So, but they make it easy on you because you don't have to jump through all the hoops in each state individually. They take care of all that because they're the employer of record. And you also can hire international as employees with, PEO type services. So that's usually my recommendation on payroll these days, because it's just so much easier. And unless you have, probably at least 50 employees, you're not really going to save enough by administering payroll on your own, that, especially with the time and everything involved, compared to using a PEO service. Independent contractors. So independent contractors, if they're US based, you have to get Form W-9 from them to get the information, and then you have to issue 1099 NEC by January 31st at the end of each year for anyone you paid over $600 to during the tax year. If you have foreign independent contractors, there's no requirement to issue the 1099 forms to them, because technically people working outside the US, they're only taxable on the services they're providing in the country that they're a resident in. But you do want to get Form W-8-BEN from them if it's an individual, or W-8-BENE. So, and Candace, sorry, I just saw your question come in, but actually that's not a dumb question. That's a great question. And I'm glad you asked it. Thank you. But But yes, the W-8 Ben is what you should get, even though you don't have to submit the forms to the IRS. That should be retained for your records in case you get audited, because otherwise you can't prove that you paid that to a person outside the US. And then the IRS can be like, hey, where's your 1099 forms for this person? So that's your proof, right? State requirements can have increasing difficulty. California, for example, now requires a withholding. We love to pick on California because they have laws like they're their own country. So they're often the exception to every rule.
True.
1099K. This was supposed to be a big change this year. And then end of December, this got pushed off another year, where 2023 is now a transition year. So basically though, this applies to payment processing companies. So like credit card processing companies is, I believe, officially the term, but it would apply if you have a marketplace. You would fall under those 1099K rules, and you would need to issue under this. So you want to make sure you're tracking and making these payments this year, or tracking and prepared to issue those 1099Ks at the end of the year next year, because all these 1099 forms usually have to be issued to the recipient by the end of January. So it's a very short timeline. If you did collect backup withholding in 2022, even though they made the transition year change, you're unfortunately out of luck, and you have to file the 1099Ks this year anyway. That is the way that rule panned out there. But the other end of 1099Ks that's really important to mention is next year, you're probably going to get a lot of these from anybody that makes payments to you. So if you sell via Stripe, if you sell via PayPal, any of these companies, then you're going to have a 1099K issued to you from every payment provider that you use. You have to make sure you go and get all those 1099Ks, because the amounts that show up on there are not going to be the same as your bookkeeping amounts in your bank account. And from what I figured out, I think the reason for that is that there may be transactions you never even see as a merchant, but the company that processes those payments will. So say somebody places an order, but they cancel that order almost immediately. That's going to show up for you as a sale, even though the money never even hit your bank account. So it's still going to show up on the 1099K. It still has to be reported in your gross income amount. If your 1099Ks are higher than the amount you report to the IRS, you will get an audit letter, and the IRS will send you a tax bill in the mail for the difference, fully taxable. So it's something that you want to look out for very closely next year. For BE12, this is another one I wanted to touch on briefly. This is only if there's foreign investors 10% or more in the company, but I wanted to mention it because this is only something that comes up every 5 years. 2023 is the year that this is happening. The next one will be 2028. So if you have at least 10% foreign ownership, you definitely have to file this. There also are certain foreign transactions like financial services provided to people outside the US, international IP transactions, or even international travel. If you've done that, that can trigger a reporting requirement on BE12. This has a different deadline than standard tax forms. The deadline is May 31st, not April 15th or March 15th if there's a partnership, but this will be May 31st on this. The forms are not going to be out until early March, according to BEA, when Lindsay finally got in touch with them. But it's important to take note of this because there's civil penalties that are between $10,000 and $25,000 that can be assessed on this, and criminal sentences up to 1 year in prison for willfully not filing this form. So definitely something you want to keep an eye out for. And if you think it could possibly affect you, I'd recommend filing because there's really no harm in filing. Additional changes that may be coming down the road. Bonus depreciation has been at 100% for many years now, where automatically you get 100% depreciation deductions for purchasing, most small equipment. However, that's being phased out. So right now it should be 80% for 2023. This is a common thing though that gets extended by Congress. So we may see this extended this year too. There's a lot of global pressure from the OECD for a 15% corporate minimum tax. There's been pressure to increase the US corporate tax rate to 23 or 24%. I doubt we'll see like 28% like they were trying to roll out last year, but we may see a small increase. We also may see increases in the GILTI and FDII rates so that they come up to that 15% mark. Also, Andre, you didn't get to me on Zoom?
Do you need a moment? I can.
Sorry.
No, you're fine.
Yeah. So it's a 1% excise tax on stock buybacks is another really important item to bring up because it can affect like an M&A type agreements. So you have to watch out if you get acquired by a company that, or for companies that maybe choose to go public via SPACs. Also, as I mentioned before, there's more states assessing income tax for remote activities. So yeah, a little bit about us and how Cleer can help you. We're business only. So yeah, we do these, tough business forums. We do a lot of international work. We do a lot of consultation work. So, these are all things that we do. We can help you with, we're here for you. We have a Gust partner page where you get a discount. So you get that 150 off code there. You can definitely get that link there. And we're going to move on to some questions, although I need 1 second here. Maybe Lindsay can answer a couple package or pragmatic questions, and then I can hop back on.
Yeah, can you flip to that previous slide just so I can steal that URL for the chat?
Here, I'll put it in the chat.
Thank you. Yeah, so some clarity. I should have said this up front. So this audience is a mixture of Gust community and Gust launch customers. So we have 2 levels of discounts. If you're in the larger Gust community, meaning you have a free Gust account for your company profile or applying things, the link on the screen is where you want to go. There's a $150 discount for some of their services there. If you're a Gust launch customer, congratulations to you. You're very well set up and your taxes should be easier to file. So we have a deeper discount in the platform for you there. Just go to your partner perks page in your Gust launch account and you'll have an access to a special link there. I think we have a couple questions we can hit, Lindsay. And I think that answers Chris's first question, which is scheduling a consultation right on the website. They have all sorts of good services. And I did drop the hello@clear.tax email if you just need to get the conversation started.
Yeah, and you can go there anytime and to hello@clear.tax, someone will help you. Oftentimes, lots of people have simple tax questions that they can answer just about, deadlines and what product is right for me. If you have a very complex tax situation, or say you are, newly formed, we also have consultations with Crystal for those more complex tax issues. And then, of course, we try to keep everything really simple. So if you go to that link, and I'll put it again in the chat in a minute, we have taxes for most small, medium, and large. If you have foreign subsidiary that requires Form 5471, if you're fortunately over $1 million or $5 million, we do have special packages for you as well. Also coming soon are foreign partnership packages that should be live in a couple of days. So there's lots of different ways. So usually we have people come in through hello@clear.tax. You mention that you're a Gust customer, and then also they will help you find the right package, especially for tax. You can add on your Delaware franchise annual filing. I like to call it the Delaware franchise annual filing because we get Delaware franchise tax. I think that gets confused with Delaware state tax. And it's just, someone asked a question about this before.
It is a tax though, Lindsay, so that's a little
It's-
dangerous because it can
Okay.
be really high.
It's a
So,
tax.
yeah,
No,
yeah.
it's a tax, but it's not an income tax. Is that correct?
Okay.
Based
Yeah,
on
it's a
assets.
it's a franchise tax. So yeah, it's based on a complex formula. Basically, the formula for Delaware franchise tax is you take the total or back a napkin version of what
Mhm.
most companies use is you take the amount of authorized shares, divide it by the number of issued shares, and multiply that by the assets in the end of the year.
That is
So
the way we preach, because all of our Gust
yeah,
launch companies have 10 million authorized shares. So if you're a
yeah,
Gust launch company, if you're a first year Gust launch company, you'll get a letter from us directly, Gust Delaware, that says it's from the IRS, but we have a cover letter on it that says, don't panic. They naively calculate your franchise taxes with the authorized share method, where they take 1 million or 10 million and multiply it by an insane number. And they say, you owe us $82,000. Do
yeah,
not worry about that. Use the assumed par value method. Cleer can help you if you get intimidated at
yeah.
all. We've got a video on our website, on our YouTube channel. There's guides within it. We will send you emails and letters and things like that. And that date is March 1st. So it's earlier than most of the other tax dates. So be sure to get that. Mark Solomon, you said $450 for one form. Should have been a question mark and an exclamation point. Yes, the minimum is $400 with a $40 or $50 filing fee from Delaware, but we will help you hit that minimum if you're a Gust Launch customer. And Cleer will help you if you're anywhere else on the spectrum, as well as navigating those horrible Department of State websites.
Yeah. So anyway, I've seen some of the questions in here. So I saw, I think Mark had written for like a 0.0001 value stock. Do we need to claim that? And I assume that's with the 83B, like a valuation for that. Typically that would still be considered like a zero value at that point when you file your 83B election, because nothing's really happened to the company at that point. Just because you paid the par value for your shares doesn't necessarily give your company an inherent value. It basically has a zero value at that point because nothing has really happened with it. I see another one that a C Corp can elect to be an S Corp for 1 year, and no, that's not the case. Once you've made an S Corp election, you have to stay with that for a 5-year period, that you cannot make another election and go back to a C Corp. You also can sometimes end up with tax in the year that you make that type of a conversion from a C Corp to an S Corp. Usually not the other way around, but definitely C Corp to S Corp side, because any retained earnings amount would be deemed distributed at the time that you make that election. But sometimes though, if you have an S Corp and you end up becoming disqualified as an S Corp, say you have 2 classes of shares, something like that, well, then you can go back to a C Corp because you're no longer qualified to be an S Corp. So sometimes you can end up with a shorter period than the 5-year period of being an S Corp, but not because you made another election to change, but because you elected to be an S Corp, then you became disqualified to be an S Corp. Yes, it's postmarked within 30 days for the 83B. You actually should send a self-addressed stamped envelope back to the IRS also, so they send you a copy of it marked filed.
Yep.
When you submit that. Are grants and private funds considered taxable income? I don't know what you mean by private funds, but grants often are. It depends on the terms of the grant, depends on who issues it, what's it for. I'd say generally, yes, it's taxable, but there are exceptions to that. Yes, R&E includes salaries to programmers. Absolutely. It's software very broad in there.
I think we had a question on what about hardware startups too? Would, like, if you're tinkering on a Roomba of the future, same kind of experimentation?
All that development's the same thing. It's the same experimentation, although it's not as broad as software. Still, any development efforts you have on the hardware side would certainly be, there'd certainly be R&E. On the plus, though, on developing on the hardware side, it's actually much easier to qualify for R&D credits for the same amount. And one benefit of like the R&D credit side is, of course, you can't both deduct the expenses used for R&D credit and have it be, have it be part of the credit, right? You have to do one or the other. So if you do the R&D credit, then it reduces that amortization. So, it's kind of beneficial there as well. Yeah, Paul, definitely you can book a call with us. We do not do free consultation calls. We only do paid consultations because we don't have a sales team. We keep our prices low by not having a sales team, having people, come to us via our website and purchase that way. Let's see.
I got some from the Q&A from early in the presentation.
Oh,
that
awesome.
get up.
Yeah.
So Daniel asks, he runs a marketplace for videographers who are doing work based on a 1099 basis. Is it the company that would pay the tax or the providers, the videographers who are being matched in the marketplace?
For what tax? I'm sorry, I'm not understanding.
This was way at the beginning of the presentation, so I think this was contractors and 1099 employees or 1099 contractors. I think it would depend who the 1099.
Yeah, I mean, I think that was answered later because we discussed that 1090 or that independent contractors outside the US, there's no withholding on, they're only taxed in the country that they're operating from.
But if your company is connecting a videographer to a customer and they're exchanging value, I'm assuming the platform's capturing some of that value.
Yeah, but it would still fall under the 1099K rules in that case because it would be a marketplace. So I'd have to look at the facts and circumstances probably more specifically for that. But yeah, if it's a marketplace, it would probably fall under 1099K rules, and it would still be exempted if they're a foreign service provider.
Yeah, I think I'll caveat the rest of the Q&A. And this was a crash course. And thank you for getting through as much as you did as you could, Crystal. And some people have noticed is like, this stuff is complicated. And why we preach to high heavens, get your business taxes done by a tax expert. This is not like your individual filings where if you just have one source of salary and you don't really, you're not buying and selling property, you can probably like stumble through TurboTax yourself. Almost always work with a tax professional for business taxes. So back with the international form 5472, if an angel group has invested in your company and there's a foreign member of that angel group, is there any tax implications there?
So if the angel group invested, I assume it would be under a SAFE or a convertible note, most likely. And on either of those cases, there is no equity investment currently. That would have been a debt type of investment. So in that case, because they don't have a equity stake, there actually is not a foreign ownership in the company in that instance.
But if later that converts further down the line into a
if later it converts, there would be a foreign ownership stake. But if it would rise to 25% to require 5472 from one member, an angel group is probably pretty low likelihood. Possibly it would rise to 10% for filing the BE12 and meeting those requirements.
Yeah, but generally, if you're getting to a preferred round, you better have tax accountants doing your taxes.
Oh yeah, absolutely, absolutely. So.
Is there a minimum corporate income for C Corp that if a company is under, do not have to pay the 21% in taxes? I think you answered that as nope. You always have to file your taxes. A couple of people have been constantly beating the drum of, but what if I don't make any money? You still have to do the filing.
You still have to file it. And we have a startup return for that reason that's really low priced, just for being able to file those $0 tax returns.
Yeah.
So, and filing it correctly.
We have one here. What is the difference between restricted stock option versus vesting options from a tax purpose? So RSU, I'm not sure if they mean RSUs.
Yeah, I mean, that's not really within the scope of like the business side. That's more of an individual tax question, to be honest. There's a number, and I'm probably not the best person to answer it because like we're business only. But from my knowledge on it, the RSUs are, if it's non-qualified, then the individual pays tax on it when it vests. Whereas if it's qualified, you can still wait till later. But that's something that you should speak to like more of an individual specialist on that end.
I think we already went through the R&E stuff. Tad says abolish the IRS. I don't think we would necessarily agree. Crystal needs the IRS in some weird weird way, I suppose.
I mean, it's kind of good in some ways that they're increasing budget. Maybe they'll have people you can actually call or talk to or resolve stuff with, because that's been the frustration is the IRS budget's been so low that you can't do anything with it. But, it's not the IRS that creates the tax laws, it's Congress. So if you want to abolish someone, you should abolish Congress members, or
We'll
at least
bleep that
change
during the
them.
recording so it doesn't
Get
exist on the
people-
internet forever.
Yeah, get people, or just get people who understand your needs. Like if you want to change the laws, you change the laws through Congress, not the IRS. So, and I've done lobbying in Washington, and most of the Congress members know very little about tax law. So, definitely that's an area where there's a lot of pushing and changing that happens. And tax laws in the US are actually pretty business friendly right now. So I don't think there's a lot to complain about except for this new R&E. And I like I said, I'm still hopeful that we'll have a late season change. So, fingers crossed it'll happen soon.
From a business planning standpoint, is that something that could happen before these deadlines even occur, or would you almost even suggest?
Yeah, so I'm actually suggesting going on extension for a number of clients who are in, either precarious or kind of questionable situations with it. We already had one come up with the depreciation issue. My opinion there, if it's like the depreciation item, I'd say there's probably going to be some clarification in the law that comes out with that at the very least, because it seems crazy that you would, not be able to deduct something that's already been depreciated that's coming through. So, hopefully we'll get some clarification. It would have been nice if there was a transition period added, like 1099K for this, but, it's already kind of come out that it's a change in accounting period. But yeah, I mean, because of the change in accounting method aspect, it's if you file the change in accounting method, and then it later, like they come out with a rule change and you can't get it amended by April 15th, you may not be able to amend this, right? Because there's some certain things like change in accounting method, you can only do on an originally filed return. So you have some ability to file superseding returns until the due date. If you file an extension before you file your tax return, your due date can be extended for the extended deadline. But it's, I think it's better in a lot of these cases to pay the tax that you might otherwise owe, go on extension and just wait and see if the IRS comes out and changes this.
Makes it easier.
And, or comes out with some better guidance that's in your favor if you're being negatively affected by this. So
all the more reason to work with somebody that can help you determine that a little upfront.
Well, and it's a good reason to start tax preparation sooner rather than later this year, because if you are going to you want to know that soon so you can file an extension and make a payment, and then at least have that, make that decision of what you'd like to do, what the risk aspect is, before too much time has passed, because we're going to get hammered with people wanting to know that prior to the April deadline, and we're not going to be able to calculate it for everyone. You know.
Isabel asks, this is kind of related to the previous question, but are investments tracked as income, and does it change whether it's an equity investment or something like a convertible? So if you raise funds, is that the same thing as just making revenue?
No. If you raise funds, that's not income. So, but depending how you raise funds, if you raise using a safe and then you close your business down, you could end up with taxable income because of the cancellation of debt if it doesn't convert to equity prior to closing your company. So that's one of the challenges you can end up having there if you don't get a forfeiture or a conversion at that point. You also, and I could see that being an issue with the R&E because there's no acceleration for the R&E. So if you have all this, amounts that are being capitalized over a 15-year period for foreign developers you've been paying, and your business goes under in 5 years, well, that other like 10 years worth of expenses, you might not be able to offset against the amount of money you've raised. You could end up with a cancellation of debt income there. So, I mean, I imagine if this continues to be law and that hypothetical type situation occurs, there will probably be other types of relief available there. That's a lot of ifs to be planning for right now, but it's definitely something I've thought about with all this.
I can cover this one super quick. Difference between LLCs, the tax differences between LLCs and C Corps. LLCs are pass-through taxed onto the individual owners. C Corps have their own corporate tax.
That's not actually true. So
What's that?
LLC, that's actually not true. So LLCs are pass-throughs by default. By default, if you, so, and there's multiple aspects on that though. So if you have a default to multi-member, it's going to be taxed as a partnership, like if there's more than one owner by default. An LLC with a single owner is, and it as a pass-through. However, if the single owner is a foreign person or a foreign company, it actually is considered a foreign-owned disregarded entity and has to file an 1120, like a corporate tax return with 5472 attached every year. And that 1120 5472 has to be filed every year, even if there's no income, anything like that. So you can end up with large penalties in that case because it's a required filing. And then LLCs can also make elections to be taxed as a C Corp or as an S Corp if fully domestic. So it has those elections available. So it's actually a pretty flexible structure. You can essentially have like 5 different tax classifications of an LLC.
Yeah, this is, sorry, I should never make so broad of answers with Crystal in the room. Generally, we're dealing the questions of like, I'm building a high-tech software company. We're like, don't worry about Delaware C Corp double taxation. If you're raising funds, a C Corp is fine. The advantages of LLC pass-through taxation, which is what a lot of people, get excited about, usually go away with, companies that raise funds and are not profitable for years and things like that. But like I've said before, LLCs are very, very flexible in ways that C Corps aren't some ways. So like, consult an expert if you're setting up any kind of arcane corporate structure.
Yeah, well, it's, and C Corps often are better because, for example, a C Corp can take FDII that I mentioned, the foreign derived intangible income discount, and LLC taxed as a C Corp technically probably may not be able to take it, I should say. I think it probably could, but a lot of the tax attorneys out there say that it's not eligible for it. So there's often advantages to being a traditional C Corp than an LLC choosing to be taxed as a C Corp.
All right. Do we have time for additional questions, or you are tight on time?
I can answer a couple more. Oh.
We'll try to get the ones that are in the queue. I'm going to pause on Troy ones while you answer the next one because I have to understand it first. Is there a sales tax for selling data?
Oh, that's an interesting question. I think it would depend on the state. Selling data would probably fall under being a digital product. So you would want to look for digital product laws in the states where you're doing business. I imagine if you're selling data, you probably only have a handful of customers who are purchasing that. So you can probably look at that specifically because it may be bigger ticket sales in particular states. So you would want to look at that kind of on a case-by-case basis.
All right. I think Troy's question is, how would a startup file expenses on personal tax forms? They've created a bank account, I'm assuming, for the startup at the end of the year, and they want to learn how to account for the expenses beforehand. So they were spending personally on the business's activities, and they didn't have a bank account, a corporate bank account set up. I think that's what that question is. Got
it. Well, typically what you want there for a corporation is an accountable plan where you've gotten into an agreement with the company where you are able to pay expenses on its behalf. But certain expenses that are paid prior to starting a company can be considered startup expenses, and you can deduct those or amortize them depending on the value of what you've actually spent.
All right. Zishan asked, do you guys assist with state filings for something like the Florida annual report? So if you're foreign qualified in the state, I guess, and that state has yearly requirements to do things.
So not the annual report, but we do the Florida corporate income tax. So a lot of companies don't realize Florida has a corporate income tax, but it does. So we don't do annual filings like in general, not in every state anyway, but we do income tax returns in every state.
Awesome.
Every state
Last
that has
one.
an income tax. Yeah.
Cool. Last one here is some clarification on the one I asked before. They weren't talking about RSUs. They meant to say that stock options given to advisors to compensate for their time. What is the difference from a tax perspective versus restricted stock options versus vesting options, which I still don't understand. Vesting is something you can put on both common stock grants and stock option grants. And you can put vesting on restricted stock grants too.
Yeah,
So
but I
I'm
don't
not
understand the
clear.
basic question
Yeah.
about what we're comparing there. So maybe they can clarify a little more. I know there were more questions still in the chat as well.
Let me see if we missed any there.
I saw one. Yes, you have to pay franchise tax even if you're pre-revenue. Delaware franchise tax is due every year. There were a couple questions to that note. What if contractors are international? Oh, those are independent contractors. Yeah, I think I already kind of addressed that during the webinar. And then Lindsay answered that one.
I think we might be good.
Yeah.
All right. Well,
All
thank
right.
you for spending another 10 minutes with us, Crystal, and kicking off a whole download of information. Yes, we've recorded this. I do not expect anybody to remember every single bit of that, nor should you necessarily, but finding good accountants and tax people to help out in your startup. Don't let it intimidate you. It is intimidating, but like people start companies all the time, thousands a year. I wouldn't be surprised if some of that Delaware hiring is because in 2021, at least in Delaware, we saw the biggest increase in new company formation that we've seen in decades, literally like 6 to 7 orders of magnitude bigger. I wouldn't also be surprised if a lot of those businesses are unwinding this year, and that's going to put additional burden on things like the IRS and Delaware, who has been behind for quite a while. But look out for more programming from us and Cleer. Like we said, we will send a follow-up. We'll have the links necessary, whether you're a Gust launch customer or not, the recording, any other helpful information we think of in between then. And be sure to get the best use out of which discount applies to you if you go with Cleer. And any parting words, Crystal or Lindsay? Lindsay, thank you so much for helping manage the very active chat and Q&A.
Yeah, thank you. It was great to be here and help out.
Yeah, that was super helpful. Thanks. Yeah, it's great seeing you.
Everybody.
Take care.